Imagine having a $500,000 stake in one of the world's largest healthcare companies. Now imagine selling every single share just hours before that stock loses 10% of its value. For most people, that's a lucky break. For a member of Congress who oversees the very laws that govern that company, that's a massive red flag. Today we are breaking down the breaking news involving Representative Kevin Hern, his perfectly timed exit from UnitedHealth, and the Medicare rate shock that just wiped out billions in market cap. Is this a case of incredible intuition? Or do politicians have a legal cheat code for the stock market? Here's what happened on Monday, January 26, 2026. Representative Kevin Hern of Oklahoma filed a disclosure showing he sold his entire $500,000 position in UnitedHealth Group, ticker UNH. His note in the filing was short: sell to close. Later that same day, the bombshell dropped. The Trump administration floated a proposal for 2027 Medicare Advantage rates. That was described as colder than expected. While Wall Street was forecasting a 4% to 6% rate increase, the government proposed a nearly flat 0.09%. The reaction was instant. UNH plummeted 8% in after-hours trading. Humana fell 13%. CVS crashed over 9%. But Kevin Hern, he was already out. Why is this so controversial? Because Representative Hern doesn't just vote on bills. He sits on the House Subcommittee on Health. This subcommittee is responsible for Medicare policy and oversight of the Centers for Medicare and Medicaid Services (CMS), the very agency that drafted this cold rate proposal. As a member of this subcommittee, Hern has access to private briefings and non-public discussions regarding payment accuracy and billing practices. When a politician in that position sells a massive stake in a sector they personally regulate, right before a negative policy shift, it raises the ultimate question: did he know the rate was going to be flat before the rest of us did? This brings us to the bigger issue. Do politicians have a real advantage in trading? The short answer is absolutely. While the Stock Act was designed to prevent insider trading by members of Congress, it's notoriously difficult to enforce. Politicians have what's called policy alpha. They aren't necessarily looking at secret balance sheets. They are looking at the future rules of the game. They know which way a committee is leaning on a tariff. They know when a Medicare reimbursement rate is going to be slashed. They know which companies are about to win or lose a massive government contract. By the time this information becomes public news, the smart money in DC has often already moved. Whether you call it good timing or something else, the Kevin Hern incident is a masterclass in why retail investors feel the system is rigged. While millions of people saw their retirement accounts take a hit on the UNH crash, those with the closest ties to the policy were shielded. What do you think? Should members of Congress be banned from trading individual stocks in the sectors they oversee? Let me know in the comments below. Don't forget to like and subscribe as we track these trades and try to level the playing field. See you in the next one.